In this video, you'll be learning about this topic. As a person on the retail side that's thinking about my deposit, my immediate thought went to that could be managed by a corporate governance structure at BlockFi in order to separate institutional under-collateralization from retail over-collateralization, and then have a parent company above that that would separate from a legal structure, would remove that risk from your retail depositors and borrowers. Is that something that you have in place from a corporate governance standpoint, or is that something that you are thinking about doing in the future?
What we have right now, I think, is better than that, which is every penny of BlockFi equity sits junior to our clients' assets in our capital stack, meaning like structurally, we wouldn't be passing through $1 of loss to our clients unless our equity was wiped out. And our equity is north of $500 million today. And one of the big constraints that goes into what portion of the lending that takes place is allowed to be credit, or how much credit exposure could we take to any one counterparty, are based on things like the size of BlockFi's equity that stands behind it.
This is my last question for both of you guys. When I think about the price action that I kind of expect in the coming 6 months to year, and I think about everything that we just discussed, it makes me think that interest rates are going to go higher for people that are depositing their funds. What are your thoughts on that? And what do you see as the primary driver for those interest rates, or the amount that you're paying out to depositors?
I think it'll be interesting to see. I could argue both scenarios. I could argue a scenario where rates go up and a scenario where rates go down. Ultimately, the drivers are adoption, liquidity, volatility, and sentiment, market sentiment. And the more volatility there is, the more demand there is to borrow. The more liquidity there is, the more demand there is to borrow. The more different types of institutions there are, the more demand there is to borrow. And on the market sentiment piece, directionally, there's less demand to borrow Bitcoin in times where the market is bullish, and more demand to borrow Bitcoin in times where market sentiment is bearish. I think rates will stay, the way I think about it is, relative to traditional financial rates, how long of a runway do we have where, for market constituents who are capturing these yields, how long of a runway do we have where they're staying incredibly attractive relative to what you can get in the traditional market? And from that perspective, I think we have a long way to go.
Long.
I think we have
super long.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.